Hi all, welcome to the next set of series which we are doing on the options trading. So this will be episode 4 and today's session we'll be talking about option Greeks. As you guys know, previous session we have talked about option basics. Even though those are basics, we talked about at very granular level. So if you guys have missed that, please do watch that. The links are available, the recorded sessions are available on YouTube. So this will be the fourth session. Yes, this will be the continuation session. So today we are going to talk about option Greeks. So as you guys know, option trading or investing doesn't get complete without option Greeks. So option Greeks plays a very significant role. Either if you are an options trader or option investor. So option Greeks is very important to hedge your risk or mitigate your risk, or if you're shorting options or if you're buying options, option Greeks are very must to understand. So the goal of the session is by end of the session you will be good at Greeks. But before that I would like to make the disclosure, this PPT is not owned by Algo Financial Learning Institute. This has been created by Fidelity Investments Trading Desk. So this is a public material. So since it is very well structured, I just grabbed the PPT and then I thought of straight away jumping into the presentation. So that's the reason. So let me quickly resume the teaching. So Greeks. So by end of the session we will be good what Greeks are, what are all the type of Greeks, how to use the Greeks, what does it actually means. So why should we know that, why it plays a very important role in managing the risk. So all these things we'll be seeing by end of the session. So before that, we should know there are many types of Greeks, but in Indian markets or across markets, there are only 5 to 6 Greeks which are predominantly common. But beyond that, there is nothing much. But this plays a very important role if you are an option trader or investor. So basically, delta, gamma, theta, vega, rho. So this is the 5 types of Greeks which is used in the market. I mean, this is must known concepts which we should know. If you are an option trader, we should know. So before going into that, instead of straight away jumping into the concepts, let me give you a quick example of a very basic thing, because uh, the entire session we are going to talk about the term. So there are two terms, one is underlying and second term is derivatives. So as you guys know, so like me, or not like me, like everyone, like every human being, so they are derived from someone. Like we come out from our parents, so we have the nature and capabilities of parents. We exhibit certain characteristics of our way our mother walk, or way our mother smile, or way our father react to situations. So we are the derived product from our father or mother, right? Father and mother basically. So basically derivatives are same. So like we derived from our father and mother, so derivatives are also same. So derivatives like options are derived from stocks, right? The stock in the sense like a Maruti stock or Apple stock or Eicher Motor stock, whichever it is. So derivatives are product which value is derived from something else, correct? So basically our values, core values, are derived from our father and mother. But of course it doesn't match 100% because we do exhibit some characteristics, but we don't behave 100%, not necessary, right? We exhibit like 50% or 40%, uh, right? So the same way, so in stock markets too. So that is the concept. So underlying and derivative. So if you're getting confused by underlying is nothing but stock, and derivatives, if you're getting confused by derivatives is nothing but call options or put option. According to uh, this entire session, so derivative is nothing but a call or put option. Okay. So now go back to the our concepts. Delta. When we talk about delta, as I told you guys, so delta is going to measure um, basically, say for example, if your father is moving by a kilometer, as a son, uh, at the same time, if your father is taking 1 hour time to travel 10 kilometers, so in 1 hour time, as a son, how many kilometers you are going to cover? Basically, both will not match, even though they will match, but most of the times it doesn't match, correct? You can be less. If your father is traveling at 100 kilometers, you can travel at 50 kilometers because various reason. Because uh, your father is very well matured. He have the capability. He have the stamina. But still, we are young, right? So we don't have that speed. We don't have that momentum to travel that speed. So delta is going to measure the same thing. So delta measures how much the uh, option price will change. The stock price is going to change by 1 rupee. Say for example, if Feature Mocha stock is rising by 1 rupee, if you're owning an option, either a call option or put option, so delta is going to tell you that how much I'm going to gain. So basically, that is the reason. So delta gives an approximation. Delta gives not an approximation, is an exact figure. It tells you how much your call options or put option is going to rise or fall in value. That is nothing but delta, correct? So if you guys are getting confused, I will summarize it one more time. So if a stock is moving by $1 or 1 rupee, and if your option price is moving by 50 paise or 50 cents, then the delta of the option is 0.50. So delta, maximum value of delta is 1 and lowest value is 0. So the reason is, if it in case of long options, right? So basically the concept is simple. If your father is moving at 100 kilometer speed, as a son, how much you are moving. So in the same way, if a stock is moving at 100 rupees, or underlying is moving by 100 rupees, how much the derivative is changing. Derivatives like call option or put option, if it is changing by 50 rupees or $50, then the delta is 0.5, right? So in some cases, if a father is also traveling by 100 kilometer speed and you are also traveling 100 kilometer speed, of course it is possible. Like stock is gaining $100 or 100 rupee, and option is also gaining $100 or 100 rupees. So that concept is pretty much same. So in that case, the delta will be 1. So delta will be exactly 1. So what does mean here is, so even if you're buying an option, or even if you're buying the stock, so if the if they are making a $1 move, the return on both will be going to be same. I mean in the dollar terms, not in the dollar or rupee terms, not in percentage terms. That is what delta is not all about. So gamma will tells you the second factor. So what is gamma? Why we should know gamma? Gamma basically tells us how much delta will change for a change in underlying price. Say for example, um, in first case, you have calculated that your father is moving at 100 kilometer speed, but I'm going to move only at 50 kilometer speed. Then you are just doing 50% of what your father is doing. So in that case, your delta is 0.5, correct? But over time, your stamina or appetite or whichever it is, the way you perform might change due to lot of attributes. So we should know um, some factor, some term to know uh, how much your delta will change over time, correct? Because the delta is not constant, delta is going to change over time, because once you get aged, so you're going to have more stamina, you can do very well than your father, correct? So you can run more than your father. So in that case, we need to know exactly how much delta is going to change if the stock is going to change by $1. So gamma actually measures that thing. So gamma measures how much the delta will change if the underlying is changing by $1, right? Okay. So now the most important thing, the vega, the third component is vega. Vega is nothing but volatility. So volatility, as you guys know, many of you know. So what is volatility? Volatility is nothing but whenever there are uncertainty, there is volatility. Correct. Whenever we are in fear, we are unsettled. Uh, when it's like a roller coaster ride, you move left and right. So it's like a guy who drunk. If you guys might have seen, he might walk left and forth, back and forth sometimes, right? So it's not stable. So vega is same. So in uncertain markets, the stock prices moves like a pendulum, upside downside, $10 up an up move, $10 and down move, large fluctuations. That is what he called as volatility. So volatility Vega number actually tells how much our option price is going to change if volatility is going to increase. Okay, so volatility plays a very important role. That is the reason Vega plays a very important role, because uh, even though if you have bought a stock option, as if you have bought a long call option on Nifty or Bank Nifty, but even though if the stock doesn't move, still there are certain cases you will make profit. That is due to volatility, because higher the volatility, higher the option price, lower the volatility, lower the option price. That is the logic, but we'll see those concepts at last. But as of now, if you guys understand the basics, that's we are neat and good. Then theta. So theta measures the time decay, which we call it as time value component. So because as you guys know, um, everything is life has a time value. So like if you have bought a bread, um, so the breads usually have a weeks to time for expiry, correct? So on day one it will be at 30 rupees, but day 7, as you get, most of you might have seen, um, on the expiry dates most of the um, breads expired was left. So what the storeroom manager or storeroom people do, they sell it for very cheap, like 5 or 10 rupees. So that is what theta measures. Say for example, um, when your option is doesn't have any intrinsic value, when it has only time value, then the entire value is say it's risk, right? So theta measures how much you are going to lose your value over time. Say for example, you have bought an option on Maruti stock call option at 10 rupees. So theta is going to tell you how much you are going to lose on a day basis or a daily basis, or for a till expiry how much you are going to lose. So if you bought a $30 call option, 30 rupees call option, and if a theta is $1, then of course you're going to lose every day 1 rupee if your stock is not moving either ways, correct? Then if the stock is at same place at end of 1 month, then you're going to lose the entire capital. So that is what theta is all about. So what rho measures the interest rate. So why rho is important? Rho is nothing but, say if market interest rate is increasing, like if RBI or if Fed is increasing the interest rate, the value of the options will increase. The reason is, as you guys know, if you want to buy a stock in the cash market, I mean in the Maruti stock in the cash market, you need to pay 5,000 or 10,000 rupees. But if you want to take the same position with of call options, you can do it for 200 rupees or 300 rupees, considering it is a one. Uh, so you can do it at a less amount. That is the reason. So when the market interest rate is high, you need to borrow the amount in the market for the opportunity cost is more, correct? So in that case, many people don't buy by paying the full amount, so they just pay a smaller amount in option markets and then they buy the call options. So that's the reason the price of options rises when the market interest rate rise. Okay, but everyone will have a doubt where I am getting these factors delta, gamma, vega, theta, rho. How to identify this? How are you telling these numbers are calculated, right? But where it is coming from, who is telling me? So there is a model. So there is a model called Black and Scholes model. So this is if you are trading derivatives without this model, markets doesn't function. So I would say this is one of the uh, most greatest invention in the financial markets, because many of the banks or option traders rely on this model, Black-Scholes model. So Black-Scholes model gives us this outputs, okay? But we don't need to know that model mathematically, because that model is very mathematics. But nowadays you will get the options calculator, which is nothing but Black-Scholes model. If you just put the 5 factors like stock price, strike price, time to maturity, risk free rate, volatility, you are good. You will get all these factors at a blink of a second. Maybe I will show you guys at last how to input, what factors to input, what factors to output, then it will be you guys will be very good. Okay, so as I told you guys earlier, so this is what the summary is all about. Delta is going to measure you um, how much the option price is going to change if the stock is changing by 1 rupee. So gamma is going to change how much the delta is going to change if the stock is going up or down by 1 rupee. And vega measures the volatility. So if volatility in the market is increasing, how much the option price is going to increase. Say for example, in the market volatility is increased by 10% and the vega number is like 20%, then your option will rise by 20%. So theta measures how much you're going to lose the option value over time. Say for example, if a theta of an option is 1, then you're going to lose every day 1 rupee or $1 on a daily basis. So rho measures the theoretical sensitivity to the risk-free interest rate, as you guys told earlier. So higher the interest rate, higher the options premium. Okay. So before this, these are all the things which you have seen. Now in options we should know one of the most important concepts, so called intrinsic value and extrinsic value. Okay, so what is intrinsic value? uh, so intrinsic value, as the name itself implies, a thing, a product which has an intrinsic value, right? So say for example you bought a wallet, so you have the purpose, you can use it for your own purpose or convenience. There is a purpose to it, there it carries an intrinsic value. Okay, let's take one more example. Say you have bought a wallet, uh, you're going to buy a wallet, so which is a very premium wallet. So but since it is out of stock, they're asking you to pay just an advance and they're giving you a voucher. Okay, so that voucher tells you that you will get the wallet by after 1 month or 2 months. Okay, but that voucher itself doesn't have any intrinsic value because you cannot use the voucher, right? So unless and until you get that wallet in your hand, there is no purpose to it, because with the voucher you can't store your money or you can't keep your cards, you can use it for a personal purpose. So in the same way, uh, so the products which have intrinsic value and products which have extrinsic value, in the same way in options market, uh, the intrinsic value and extrinsic value is same. For example, uh, it all depends on the stocks and strike price which you choose. Say for example, if you're going to buy, so in this case the stock price of the is currently 74 rupees. Okay, so if you're going to choose a strike, if it is a call option, and you're telling that I will buy the stock at 64 rupees at end of 1 month. Okay, so which means uh, the stock price in the market is trading 10 rupees more, so which means already it has some intrinsic value, correct? You have bought 10 rupee less, so you have a 10 rupee value to you, correct? So your stock is now 10 rupee value more to you, correct? So that is what intrinsic value. Now let's say one more example. The stock is trading at 74 now, but you are saying that I will buy the stock at 80 or 90. Okay, but if you see stock is still at 74. Okay, it doesn't reach your hands. Like in the similar case, it's of wallet, it is still in the producer hands, it doesn't come to your hand. Unless and until it comes to your hand, it doesn't make any value. In the same case, unless and until the stock price comes to 90 or reaches beyond 90, it doesn't have any intrinsic value. As of now the intrinsic value is 0, correct? So that is what option Greeks is all about. So intrinsic value and extrinsic value. So now why this is important, intrinsic value and extrinsic value? So what happens is, so higher the extrinsic value, higher the risk, as I told you. So if that value is 5,000 rupees and they have just given you the voucher, but the company is in US, okay, due to COVID you are not going to receive the wallet, what you are going to do with the voucher? You can't do anything. You can go to the store, but the store guy will tell you due to COVID I can't give. So it loses the value over time. So it loses the value over time, correct? So if the company shut down and if you're not getting the value wallet to your hand, it loses the value over time. So that 5,000 rupees, it will slowly depreciate and sometime it will become 0. So in the same way in stocks, when you're choosing an out of the money option, so you lose the value over time. So you lose the value over time because the stock doesn't reaches the strike price. I mean, doesn't exceed the strike price. So that is why the theta, the time value factor for out of the money options, that is what I mean is, the time value money, which is nothing but the theta factor for extrinsic value options, is heavy. That means you have more chance of losing money every day. So that is what, but it doesn't mean that in the money option doesn't have theta factor. Of course they will have, but their theta time decay factor will be very less. Okay, so I think if you guys know this, then we are good. Okay, why delta? Because this is one good information which they have given. The reason is three common reasons they have mentioned. uh, as I guys told you earlier, how much the option price will change based on the dollar move in the underlying. Second is, uh, so it will give you the equivalency. So what I mean is, say for example, if you are an option trader and also if you are trading in stocks, okay, so it will tell you how much options to buy or how much proportion to buy. Okay, you can buy 100 stocks and you can buy 50 options, or if you want to take same position like stock, if the delta of that option is only 50, then you have to buy 200 options, something like that. Correct? You have to, since the option is performing only at half speed, you need to make it double to make it one to perform it at parent speed, just to match. Correct? That is the reason. So as I guys told you earlier, it just give an approximation that probability that option contract will expire in the money or out of the money. So the reason is, so I when your strike prices in case of call options, long call option, when your strike price is very less than the call stock price, then we call it as deep in the money. So for deep in the money options, delta will be 1. It is something like this. um, your father is 60 and you are reaching an age of 40 or 45, whichever it is, or 40 or 30 or whichever it is, then what happens is, you are more or less, you will function at the speed of your father or mother. Correct? So the delta will be 1. So if your father is traveling 100 km speed, you can also travel. So that's the reason. So it gives an approximation whether it is in the money or out of the money. So that is the one. So this is one example. So which they have mentioned, a long call with 50 delta should move approximately 50 cents with $1 move. So correct? So if your stock is moving by $1 and your option price will change by 50 cents or 50 rupees. Correct? 50 paise. Correct? Okay. So gamma tells you the same thing. Almost the delta will change for if almost the delta is going to change if the stock price is going to change. Correct? So gamma is going to change. So gamma is not constant. Delta is going to change. Delta is not constant. As I guys told you earlier, theta is nothing but the time value component. It is a risky component. When your option has high extrinsic value, which is then it is a theta value. You lose time value over time. And Vega measures the volatility. So in Vega there are two things. One is uh, implied volatility and second one is historical volatility. So what I meant by historical volatility is, this is very important because say for example the market, many people will know the India VIX or volatility index. Okay, if the volatility index value increases, what happens is your option prices will increase, but at the same time there is one more concept called implied volatility. So implied volatility is nothing but options volatility. Options volatility in the sense, it is purely based on the demand of that particular option. But historical volatility is based on the market, but implied volatility is based on the option price. So that is the difference which we should know, because higher the implied volatility of an option, so that means there are higher chances that the option have very high extrinsic value. The reason is, it's morely like when the implied volatility is very high, the reason is there is more demand for that option. That option is fluctuating more, So what happens is, if more people are buying, so demand is more, price will be more. When price is more, risk is more. Since in options, higher the extrinsic value, higher the risk. Higher the risk, higher the extrinsic value, higher the theta factor. Higher the theta factor, you will lose the money very speedily. That is what it's all about. So rho measures the interest component. So this is less significance in Indian markets as of now. Interest significance, okay, very less significance. But Greeks, so where do I get Greeks? Okay, as I told you guys earlier, so Greeks we will get it via Black-Scholes model. That calculator is available online as an open source, but I will tell you guys how to input and output, get the output to make a better plan and trade. Okay, so all these things we'll talk about that only. So before going to that, I'll quickly show you the options calculator. Okay, how it works in terms of Zerotha. Options calculator by Zerotha. So here we go. This is the option calculator which we are talking about. Uh, so this is the spot price. This is the spot price of Nifty. Okay, this is the spot price of Nifty. Say for example 15,000, which is nothing but the stock price. On strike prices, you are telling that I will buy the option. I will buy the Nifty at 17,000 after after a month or so, at the end of September. Okay, so the volatility in the market is 20% and the market interest rate is 8%. So what happens here is, when I give the calculator, you get the call option and put option price. Okay, so you guys can see the call option price is very less. The reason is uh, it is an out of the money option. Still the stock is very less below the strike price. It is yet to reach that destination. Until it reaches the destination, it is worthless. So that's the reason. So you can see delta is very less, because your option will not make a huge change unless and until the stock price make a huge drastic change. And also the same way, you can see, guys can see the theta factor too. So the theta component is huge, because you will lose every day $2.80 or 2 rupee 80 multiplied into lot size if the stock is not moving anyway. That's the reason if you're buying an out of the money option, um, it is risky. You will lose the premium and all those things. So volatility, you can see volatility is 2.568. That means if market volatility, historical volatility is increasing, then your option will gain by 2.568 percentage. So it will change across 8.10 into 2 percentage. Okay, so that is what is all about. So basically this is the calculator. So behind this there is a model called Black-Scholes calculator. So but we don't need to know the mathematics, but if you're good in knowing the input and output, we are very well good at it. That is what is all about. What else is left? So if you guys feel anything is left, you can post me or post your observations. Anyhow, we'll continue in episode 5. So anyhow, I think this will be useful. I think so for options Greeks. Please do let me know. You can write to us so we can continue this series and we can address any missing points in upcoming sessions. Okay. Thank you. Thanks all.